what made you start there? You know?
Yeah.
And I don't know if I want you to answer this because a lot of people look at me and they ask me the same question. They're like, well, why are you in Jersey? You know, why do you do whatever in Jersey? It's like a secret sauce. I don't like to tell everybody, but I mean, you obviously started there. There was a reason why you started there. So.
It's easier than New York. I think that's what it is, right?
I mean,
the brokers aren't as good.
The total dollar volume. I mean, New York, the five boroughs, it just blows away when you add it all up.
Yeah.
But there's obviously a reason why.
New York is the beast. All right, welcome back. We're here at the Real Estate Roundtable with IPRG. We have some more guests here today. We have Andrew Miller and Brennan Bicknese from Skylight Real Estate Partners. Welcome, guys.
Thank you for having us.
Glad to have you here. I'm also joined by Luke Sproviero and Yanni Marmaru here at IPRG. This is Derek Bestrick. You guys have a lot of friends in the office. We've done a lot of business with Andrew over the past 10 years as a company. Yanni's done business with Andrew in Jersey.
That's right.
We've done business with Andrew in New York City.
That's right.
And Brennan has friends in the office as well from growing up.
And all over the place, apparently.
Yeah, so happy to have you guys in. It's been a while since we connected last.
Way too long.
Yeah, way too.
We're not going to have that happen again.
Well, in fairness, I mean, you kind of slowed down the activity in New York City. I mean, you came into New York. It was one of the best things I ever saw. You started buying up like everything.
That's why we brought Yanni in, so now we can start doing deals with Andrew. Right? It's the whole reason for Yanni's entire team.
Do you remember? It was I guess I can go into. I'll touch on this. One of the first times that we met there was this deal. It was a Miller deal. Remember that?
One of the Bernie Miller deals.
One of the Bernie Miller deals. That we got an allocation from our capital partner, and they're like, we're gonna give you, I think it was like $60 million of equity or something like that.
Yeah.
And go.
It was $60
million
The
bucks
purchase
of
price was
equity.
$60 million.
No, but he had $60
I had $60 million
that he
to spend.
To spend. He was trying to spend.
And we spent
equity.
it. Didn't we spend it? And then we got
No, we didn't.
No.
There was
capital partner.
No, there was 20. It was 25.
They're not around anymore.
Dude, so it was 25 and 35. Remember, 25 million and
Luke,
35 for
Luke,
flats.
You're talking about the purchase prices.
Yeah.
He had $60 million of equity to spend.
Yeah.
So we came in contact with Andrew and his partner first, and Andrew was one of the first guys, in my opinion, to bring like major institutional capital into the rent-regulated section of the Brooklyn investment sales market.
Yeah.
But I forget how we met. You may recall.
It was 75 McDonough.
I know it was 70. Yeah, so it was 75 McDonough. We had 75 McDonough on the market for. What's his name? Michael Williams.
Yes.
No.
Harris.
Oh, maybe it was.
It was Michael Williams.
Whatever.
It was the
It's a long
Raleigh.
time ago.
Remember it had the
The
Raleigh.
Raleigh. It was the
written
Raleigh.
up by the cornice.
Yeah.
And Andrew and his partner came in and saw just what a beautiful corner property it was. They saw the value in it.
Well, the way it actually worked. I don't know if you know
right,
the full story was we were buying rent regulated stuff in New Jersey. And the whole idea behind it was that you were buying let's call it was like 6 caps at the time. And the partner that we had was a REIT. So they had to return to their investors, it was like 4% was minimum. So I went and I pitched them on the strategy where you're gonna buy a 6 cap, you're gonna finance it, at the time it was like 4.5% money. So you're generating like a 7 cash, like an 7.5, 8 cash on cash return. And I was like, after you guys take your 4, we have like positive cash on cash that you don't have to distribute. So let's look at some kind of a cash flow split promote immediately. And then there was a capital event promote that we also had with the partner. And I was like, the rents are inherently like 50, 60, 70% below market. And you have this ability to go in, right, and renovate apartments when people vacate. And you can pop the rents. And every single time you do that, we're talking like we're just unlocking all of this value. So it's like you were getting to your threshold immediately for what you need to distribute, plus, and then on top of that, we're just able to continue to create additional cash flow. And they were like, "This is an unbelievable plan. Let's do it." This is obviously before all of the regulation. So we started.
When was this?
This was in 2010 when we started with them
in Jersey.
Got
it.
Exactly, and we started with you guys in
14.
14
we did those deals.
14.
I think.
Yeah, it was
So
14.
10's an unbelievable time to get into that market.
It was crazy. Well, I was a broker before that, and at ABS Partners, which was kind of a.
More office, right? I mean,
It was
that's
office. It was
yeah.
office, and one of the things that was funny at the time is, we talk about this all the time. I didn't know anything about residential, zero, nothing. I was like 24 years old, and I made some commission, and 2008 happened. There was nothing to do, and I took the money. I went to Earl Altman, and I was like, I think I'm going to buy an apartment building in Passaic, New Jersey, because my buddy Rob Squires had a listing. And he's like, you don't know anything about residential. What the hell are you talking about? Residential. And I was like, yeah, let's just figure it out. And I went in and started. I was the super in the building and learned kind of like building systems and renovations and through doing that and then kind of started scaling from there. But the interesting thing about the raise and when we was that was like 2008 that I bought that building, and then we bought another building after that with family and friends money. Then it was another building with family and friends money, another one in Montclair. And then after that, that's when I went to this capital partner and I was like, let's here's the idea and let's do it.
And that was in Jersey City.
That was all across Hudson County. So the whole plan was like Union City, Jersey City, West New York, North Bergen, Hoboken. It was all across Hudson County. They came to me. This is how we met. They came to me and they were buying 1 to 4 family houses in Jersey City. They shifted the strategy to Brooklyn. And they were like, we want to buy these 1 to 4 family houses because there wasn't rent regulation. They didn't understand how to get through the documentation, paperwork of rent regulation. So they were like, we have you guys, and there was one other group that basically they did rent regulating investing with as operators. They were the equity, we were the operator. And they came to me, I'll never forget, and they were like, there's this building, 75 McDonough, and we want to buy it. And I was like, I don't want to buy an 8-unit building. I was like, we own like 500 units with you guys in Jersey City. We have like a whole operation, and we have scale and trucks and payroll. Like it's a whole moving machine.
Yeah.
I'm not buying 8 but over there, like we're not doing that. That's ridiculous. And I was like, but if you give me an allocation of dollars so that we can grow this business and it's not just a one-off, let's look at it. And that's when we met. And so we went on the tour. We met on the tour.
That's right.
And I was like, $60 million to spend. I was like, let's do it.
$60 million of equity.
Equity to Scott.
I raced back to the office and I told Luke, I think you weren't there on the tour, and I told him like, hey, these guys are about to go and buy a lot of stuff. What can we sell them? And then it was like a scramble to find every property that we could think of that we could send them. That was a lot of fun.
You're also at a point where the market is kind of like this.
Yeah.
It's not even anywhere near where
That's right.
You would have gotten burned so bad if you did that today. Now it's like back in there's a lot of wiggle room.
There is so much that would have, so much of this business is timing.
Yeah.
You have to know what you're doing, but so much of it is timing you don't know. But the Bernie thing, which I'll never forget, we're trying to spend this money. and find good deals.
Yeah.
So there was a Bernie Miller deal that what's his name?
Yechiel?
Yechiel, John Weinberger was managing he was in the basement of the building. And we're talking, and we're like, we're gonna make this deal.
Which building, 770?
No, we didn't end up buying the deal.
Oh, okay. This is the one on Clinton and Grand?
Yes.
Yeah.
Washington Flats,
Yeah, Washington Flats.
which is not a great building now, but
And that had like a didn't that have like a regulatory
yeah.
agreement or something?
It had
did,
regulatory.
it-
It was 5 buildings.
did, yeah.
It did. It was
And
a
that-
full. It was like a half a. It was a full block.
It was
or
like a cluster. It was like a solid quarter of a full city block.
Yeah.
It was a lot of buildings.
Yeah. But we went there, and we were trying to make this deal, and then what happened was, for whatever reason, Bernie goes, "I don't want to sell the building,"
Yeah, classic.
and I was like, "That's not happening." I said, "Derek, get into your car. I'm getting in my car from Jersey. We're driving there now, and we're gonna make this deal."
Well, didn't we already have accepted offers on 770 St.
We
Mark's,
did.
637 St. Mark's,
Yeah.
2430 Rush?
We
So
did.
So we had
We
a
did.
$25 million deal in place.
Yeah.
And that was not
And like
30.
we were touring those properties with John.
Yeah.
And then we get like in the back of his car. He's like driving us around.
Yeah.
He's like, hey. He's like, I've got
That's
another.
right.
He's like, I
That's
got another
right.
deal. It's 124 units.
Yeah.
He's like, it's just over here in Clinton Hill.
And
He's
we're
like,
like,
I'll
"Are
take
you-"
you. Come with me. So he takes us over there. We like walk the building.
That's right.
We get through all the due diligence. Yeah, and then we obviously saw the regulatory status. But that was an epic moment in brokerage. Like,
Yeah.
Like I'm sitting in my office and it was it was like a $60-something million deal or 59 that we had on the table, and like it was like ready to go, and all of a sudden Bernie pulls a huge piece of the deal.
Yeah.
In like almost like classic fashion to like try to see how much room they really
Yeah,
have. 'Cause
that's
he knew-
exactly
he knew,
right.
He knew they had a lot of money and was willing to see how far can I push them on
That's
price.
right.
So he pulls away like the main piece of the portfolio, and Andrew's like, no. He's like, we're not losing this deal. He's like, Derek, he's like, I'm coming to your office from Jersey.
Yep, that's
right
right.
now. He's like, I'll be there in an hour.
Yeah.
It's like, I'm picking you up. We're going down to Borough Park, and we're gonna go see what's going on with
Yeah.
these guys.
We all,
You can't.
We all,
Yeah, that's right.
So Andrew pulls up.
we were in a Lexus, I remember.
That's right.
The Lexus.
The Lexus RX.
Andrew pulls up. We drive down to Borough Park. We park the car, and we just walk into Yechiel and Bernie's office. I mean, these are major landlords in the city. We just walk into their office. Yechiel's sitting there with his shoes off, just has his socks like, on his desk. Just walking around with no shoes on.
That's right.
And Bernie's in there like showing us
Yes.
a map of like every building that he ever owned.
And his son was there.
Yep, Eric.
Eric. And
Great guy.
And we were hammering. We were there for hours.
Yeah.
Working
So
on.
what ends up happening?
We ended up not getting that deal. The deal. Listen, I believe that everything happens for a reason. That was not a good deal.
Someone else came in and paid more.
No, Derek and I
Paid
got
more.
Well, Derek and I got screwed because it was a $60-something million deal. We had a 1% commission, which was obviously $600-something thousand.
Which we were happy with.
We're very happy
in
with
the 60s, yeah.
$600-something thousand, $100,000, and then he pulls. So we ended up doing 25, and he still kept it at 1%.
Yeah.
So then so then it didn't feel great, but we
It
still
did.
very,
that really did not feel great. Not to
We sat there
belittle
with the
it, 'cause
money,
It's,
we're like,
it's still
ah.
great, but yeah, it didn't feel great. But
So wait, before we go,
Yes.
I got some questions.
well, hey, I want to say real quick, and then you can ask your questions.
Sure.
This was like as I look back on my career and like major takeaways and lessons and things that I really just thought were valuable that I saw when Andrew had this whole thing. You go to their office and wait. And I forget the story, but I think there was like a big office landlord you were trying to get in front of, and you went to his office.
That's right.
Sat in the lobby for like 8 hours.
That's right.
And eventually he met you. And so
It
that was the whole.
It was
theory.
Larry. It was Larry Silverstein.
Yeah.
It was so Earl Earl's old, close, and he used to drop Larry's name all the time. My friend Larry Silverstein. I don't know if you know. I'm like, yeah, of course I know who Larry Silverstein is, Earl. And he's like, one day you'll meet him. One day, okay. And so there was a building that we were trying to negotiate a lease on, and he goes, "You go to Larry's office," and I'm like, "What how am I? What do you mean go to his office? I mean, what are you talking about? He's like, that's how we do business. You go there and you wait, and they'll eventually see you. And I did it, and I saw Larry, and we didn't make the deal. But but it was one of those things where you're like, if you get in front of someone and you're just persistent and you're not an asshole, but you're persistent and you can back up what you're saying, I think it goes a really long way. It's always worked for me my whole career, and I've done that since. That was one of the more memorable ones, but I have done it since where I'm like, I'm just gonna show up. And I did it, I actually did it 2 years ago. I couldn't get this guy on the phone. It was the guy owned this like wonky REIT, and I wanted to buy the whole REIT. And it was in the middle of COVID, no one had been in the office, and I got some intel. I called his secretary, and she was like, she said something like he'll be right back at his desk. So I knew that he was in the office, and then she was like, but he can't take the call. Like it was something like that. So like I knew if I knew that like he was, I knew that he was there. I knew he was there. So the next day I showed up there, and she's like, he doesn't have time. I was like, I'll wait. And she's like, 5 minutes later, she's like, all right, come on in, and I'll see you. Yeah. And we spoke. The deal didn't work, but I still speak to the guy, and like someday, I think it'll happen.
It's amazing.
You talk about like the old school guys and the way they used to do business, and that was it. There was, they didn't have whatever, iPad, cell phones. They would just go to people's places.
That's right.
Show up. And I say this because I have like 4 young guys now working underneath me. And I tell them stuff like this, and they look at me like I'm crazy. Like, this is how it was done. This is, especially with the old time guys, this is what they're used to.
It still is how it's done.
Yeah,
It's
but not with the new generation. I think is
texting, emailing.
They're afraid. They're afraid. In some cases, it's like something that they're just not programmed to do.
But I learned a lot from that too. I was very young when we were doing all this, obviously, and I was new to the game, but. You were very efficient, right? We get in the car, we're going, and then it just worked out. And you went in, and Yehiel Weinberger is not an easy person to talk to, and he got that done. You spent $60 million damn quick, which was really fun, and it worked out. And it was just it was really good to see. It was fun.
Yeah, and then he bought all those other deals too.
Yeah, and every deal worked.
The deals again. This was a timing thing. Yeah. For sure.
Oh, yeah.
We vacated the hell out of the buildings, and we were going to start renovation work, and our partner wanted us to use their construction company. We didn't want to use their construction company, and we got into a dispute over it, and we're like, you know what? Market's gone gangbusters. Mm-hmm. We're not going to make as much as we thought we were going to make, but we're still going to do great. Let's just sell, part ways, and let's just do other stuff. Mm-hmm. And I moved to start working with Bennett at that time.
Yeah.
And we ended up selling. It happened to have been the best time that you possibly could have sold that stuff in the market. 2015, 2016.
By months.
By months.
Like anyone that's holding those buildings right now, it's
not
obviously
good.
Not looking good.
Not good.
Yeah,
and
it's unfortunate.
I also, and that's what I was saying. Like, I also very much believe, I was talking to someone today about this, that I want to leave money on the table for the next person. Like, if I can make money and then the next person makes money, like, I actually feel good about that. There are people in our business that want to make sure they've ripped every penny out of every single deal, and that the next guy's gonna lose every. I think that there's a karma thing, and if I'm doing well and I want the next person to do well, I'm very happy with that. That makes me happy. So it was unfortunately a full bloodbath after 2016, and then the rent laws started getting more and more difficult. Remember that when we sold the last building, we sold McDonough.
McDonough became a really tough deal. I mean, Ken Fishel ended up taking a big loss on that.
Sucks. sucks.
And
It was the tenant.
He invested a lot of money into it, and he did everything right. But
It sucks.
the tenant.
Well, Ken also got out of the market, timed it perfectly. He made he can't
on
feel
his
bad
other
for that guy.
properties.
Yeah, he was
But
a genius.
you know what? In a
Yeah.
way, I feel like 75 McDonough for him was like the canary in the coal mine in terms of what was going on, and he like got like a forward look into what he saw happening in the market, and he's like, you know what? He's like, I don't want to do this anymore.
He got out the
And
perfect
he sold,
time.
yeah. What he sell his entire West
He
Village
sold,
portfolio.
he sold West Village, Prospect Park West, and Park Slope.
yeah.
And then right before COVID, he sold his boutique office buildings.
Well,
It was just mint. He was good.
So that's kind of interesting because it's like if you can get some perspective on something that's as minor as 75 McDonough and then use that to parlay into a thesis that you're going to start selling. I mean, that's awesome.
I haven't spoken with him about that, so I'm just assuming that was the case. But he bought 75 McDonough. It was a gorgeous building. We sent out
Beautiful.
a postcard when we
Sick.
were marketing it, and
Building
he
was
got
sick.
the postcard and he bought it off the postcard and he bought it for his son. Like
Yeah.
that's what he bought it for, and then it turned into being like beyond anyone's abilities to manage.
Yeah.
You remember we bought that when we were doing this. It used to be crazy. It was like there are no records. The people who own it live in North Carolina. They've owned it for like 40 years. Like the grandfather passed it down. It's amazing. There's so much upside. And like then by the end, it was like if you don't have every single piece of documentation, this deal is worth nothing.
Wow.
That was like all 14 and 15. We just sold like 2 caps with amazing stories.
That's
Yeah.
right.
Amazing looking buildings, amazing stories behind it, no cap rate, no paperwork.
No paperwork.
Everyone left for like $10,000.
That's right.
And now
10,000 was the buyout back then.
That's right.
they're like 80 New York, 70 New York, 75 McDonough,
Crazy,
all those
crazy
buildings we
stuff.
sold.
Yeah.
And a lot of
that's-
people took a lot. There's a lot of pain on a lot of those buildings at this point.
So many
It
amazing
sucks, and that's why.
Yeah, it does suck.
And that's why. I mean, listen. From a political standpoint, it's not great for the housing stock. Obviously, right?
Yeah,
It doesn't really
we were
make
talking-
sense
We were talking about this the other day.
to put money into the deals anymore, right?
And also
In Jersey as well.
Well, no, the exodus of capital, why it's leaving, I think.
Yeah.
I mean, if you look historically, like what's been happening, and especially with the inflow, it was going to go back to the original question I was going to ask you: is why Jersey? Like, what made you start there? You know?
Yeah.
I don't know if I want you to answer this because a lot of people look at me and they ask me the same question. They're like, well, why are you in Jersey? You know, why do you do whatever in Jersey? It's like a secret sauce. I don't like to tell everybody it, but. I mean, you obviously started there. There was a reason why you started there. So.
It's easier than New York. I think that's what it is, right?
I mean,
The brokers aren't as good.
the total dollar volume. I mean, New York, the 5 boroughs, it just blows away when you add it all up.
Yeah.
But there's obviously a reason why.
New York is the beast.
But it's sometimes hard to get people like Andrew who are in that position that could basically, they can go wherever and do whatever they want. To say to them, come take a look at a place like Jersey. Come look at Hudson County. Come look at, Passaic.
I was saying that like the way that I look at things just in general is kind of like in extremes, because I think that like I think it's the best way to get perspective on things is if you like take them completely out of context and you look at something in like very very black and very very white. And when I was looking at real estate in general as like a profession, I was like, I would like to do fairly well with my job. Like I'm doing this to make money and to make a living. I didn't know any of the other stuff, which I happen to love so much of this business. And I was like, there's a lot of people that make a lot of money in this business. And again, I didn't know like what a broker was or a leasing person or a finance person or an investor. Like I didn't know like what all of the different categories of professions within the real estate profession. And so, but I was like, there's a lot of people that seem to make a lot of money here. Versus, I was like looking at, I was doing some music stuff, and if you look at the amount of people that make that much money in the music business, like there aren't that many people that like make that much money. Yeah. So I was like, so real estate seemed interesting. I also like seemed interesting that like I kind of understood it. It like made sense to me. Like it wasn't such a crazy, complicated business. Again, this was like very rudimentary at the time, but it was like there's rent that comes in. You have these like expenses. I don't know what they are, but and then like at the end, like there's some money left over, and you like use that to like but that was like but if someone was like, "What's finance?" I was like, I don't know. I don't even know what that means. Like I couldn't even. So for that's kind of what the initial like infancy thinking of kind of switching from like doing music stuff to real estate. This is long time ago. And then what I thought again in extremes which was interesting was that like I thought two things. Number one, when I went to go out and buy, I was like I wanted to always kind of have an institutional business. And I was like, I think I can get there much faster in New Jersey because the buildings are cheaper. So like I can use a lesser amount of dollars and buy a bigger building. And if I can get to like 1,000 units, that was kind of always my thing. If I can get to 1,000 units, I can go and pitch like some institutional someone to be like, this is what we have. This is the team that we built. We're running about 1,000 apartments. It's kind of real. And I thought that would kind of be the litmus test. I didn't know what the hell I was talking about, but that was like the litmus
In theory,
test.
it sounds great. Yeah.
It sounded 1,000 units sounded like you like had enough, right, to like kind of go and speak to someone and for them to take you seriously. And I was like, for me to do that in New York City is going to cost. I don't know. First of all, I don't know where I'm raising any money from. And then number two, I was like, when I made this commission, it was like, I think we put in like 300 grand at the first deal. I mean, maybe it was less, like 250, something like that. And in New York City, to like, what did I bought for $250,000? I mean, of equity.
A six family in Bushwick.
I bought a 24 unit in Passaic.
Yeah.
It was like two real buildings. Like, I mean, but there were two buildings. It was 12 and 12 next to each other with a driveway. It was like a real, felt like a very real thing versus a 6 family in Bushwick.
Yeah.
You know what I mean? Yeah. So I was like, this is pretty interesting. And then the other thing, again, back to the extreme thing, I was like, there's a lot of people, and this is maybe a little bit secret saucy, but there's a lot of people that have made a lot of money in New Jersey, right? Like if you go through all of the families that are worth a tremendous amount of money, they've done it in New Jersey real estate. So it was like, and I know some of them from kind of growing up. So I was like, I'm not really embarrassed to go over there. And if that's where I'm going to be able to make money and I can buy kind of more scale, sure, I'd rather be in New York City. But like, eventually I'll kind of cross the river at the right time.
Yeah.
And that was the reason for doing that. Now we're Jersey guys. So now,
now you guys are still continuing to be extremely
We went to
active.
New York and now you're back to Jersey.
We went to New York. We're back to Jersey. We are working actively on a deal, like our first deal in like a year.
In New York.
In New York.
Yeah.
Really?
Are you trying to get out of New York? I mean, you guys have you sold most of the stuff in New York. I thought you guys were done with New York.
No, it was more like we kind of look at things where it makes sense. Like that's kind of a little bit more of what we do is there aren't that many people that do New York and New Jersey. There are some, but there's not like a lot of people that like will float fluidly across
There's like
the
some
river.
small owners, but not like big guys. Doing
Kind of, not really, right? They just kind of, it's not as fluid. Some people do, and again, like you have like Iron State, like did some stuff, but it was like Dave stayed there and Michael was here, right? And like, there weren't like huge monster families that kind of did float. The Kushner, obviously, Charlie did it, and Mari did it, I think. But there aren't that many people. So we do understand both these markets really well. We have 4 partners at Skylight. So, Ben spent his whole career, Ben was at Related for 22 years, building apartment buildings in New York City. So he doesn't even know New Jersey. Like so we when we talk about New Jersey, he loves it now because we've been. He sees what we've created, but he doesn't know what that is.
Yeah.
He's
That's
like
like these two. They don't
they don't know. He has no idea. Exactly.
Jersey confuses me too much. All the different rules and regulations.
That's crazy.
Yeah.
Taxes.
Yeah, I just feel like I don't have the clarity there that I have in
Yeah.
New York. But it's
But
a
But,
novel
but
experience.
I'm the exact opposite. Like, someone tells me to underwrite a multifamily and whatever here in New York, and it's like, psh, there you go. I don't even want to think about it. Doesn't make sense, especially anymore. I think I used to be able to.
Yeah.
Yeah, I mean,
It's true. New York is very complex too.
you know what? So the thing that we're looking at now in New York, which is probably, I would like to think that it's the only thing that we would kind of look at from a multi standpoint in New York. It's 100% free market. It's 100% taxed,
Yeah.
and there isn't a union contract, but there may as well be. Like the payroll's tremendous. And you want all of those expenses loaded in, so like you try to eliminate the surprises, right? It's like if there was a tax abatement, but like it's gonna phase in, or there's an affordability component and they're gonna change it on you, or like the union's not there, but they're definitely gonna implement it. Like, so you wanna like have all of that stuff phased into a deal when you buy it, so like you try to eliminate as much surprise as you possibly can have down the line. We've had a lot of surprises in our career that you can't underwrite. So we try to learn from that. So, but I would say that like Jersey is we've seen more opportunity, less political constraint over there than we saw in New York. We have gotten hurt with regulation here in New York City. There's less regulation, different regulation in New Jersey. What's interesting is that there's 100 and something municipalities in New Jersey. I mean, it's like
That's how it's different.
525.
They do it by municipality.
525, something like that.
525.
Yeah, I mean, you're talking about little
Tiny
towns
little
down to
municipalities.
Atlantic
And they all have
yeah.
their own.
They're all their own rules.
Yeah. The,
Their own rules.
the majority of the cities, the majority of the towns in Jersey, they can't control. There is no rent control because they don't have the support, the staff
That's
to
right.
monitor it, to keep all the paperwork. It's the large cities. It's unfortunately a lot of the cities around here that do have it.
Yeah.
So you can go into most municipalities.
Bayonne doesn't have it, right? Bayonne, no.
Bayonne has vacancy decontrol, so that the tenant leaves, and then you could basically
That's like that's right by Jersey City. It's next door.
right next door.
Yeah. So the thing with vacancy decontrol, it's the same thing that they're talking about good cause eviction. Mm-hmm. So that's what's kind of interesting, I think, for Skylight and us. We don't really care about good cause eviction.
Yeah.
Like, I'd rather it not happen because I think that it's not that helpful, but we're so used to it because we've been dealing in New Jersey and all of these municipalities where like it's vacant, we call it vacancy decontrol. Here it would be called good cause. Again, don't want it, but we know we've underwritten this our whole lives. Like we know it so well. So like that doesn't scare me as much as some of the other things that are happening politically here that are challenging. But that's part of the barrier to entry in New Jersey, where like a lot of people don't understand every single nuance of every single town. So it's like it's harder to do it than like
Definitely.
right? If you own in Brooklyn or Manhattan or the Bronx or Queens, it's all the same.
Yep.
And there's so much product here to kind of buy and trade. It's hard. It's harder now because politically it's harder.
Yeah.
But Jersey, I liked that barrier to entry thing there, and we just know it now,
And
right?
you started out buying and owning it.
Buying it and owning it.
Kinda
Well,
learned it
I
from the
feel like
ground
too,
up.
like
Yeah.
the little bit I know about Jersey City, like Journal Square, take it. It's very like similar to what Brooklyn was in 2011 for me, where there's a upside play, right? You can move tenants, like
Right.
they can move. There's affordable housing that they can go into, and there's an amazing transportation.
That's right.
There's a Jersey, if you look at it really quickly and get an idea of how the path works in all the different areas, it's a no-brainer. You get off at Grove Street, and you're like, holy shit. It's like Williamsburg.
What about
It is.
further out, like the
Harrison?
Well, just like the New Jersey, like
Suburban.
yeah, like the railroad,
We did it. Listen, we're getting unbelievable rents out in Jersey in kind of like further west.
In like Essex County.
Essex County. We talk about it that there's like New Jersey, New York are not growth states. So when you're talking about it from like an institutional standpoint, we're shrinking from a population standpoint.
Yeah, it seemed like for the past, not to cut you off, for
Yeah.
the past couple years, that type of talk, that institutional, I want to go to the growth states.
Growth states.
Everything was focused down south.
Growth.
It almost seemed like institutional capital was going to
Growth
evaporate from here.
Growth states, yeah. That was the whole thing. It was like
Yeah.
growth states.
Yeah.
And then when we talk now, and people aren't really doing a whole lot right now, but when you talk now to partners, what's interesting is that we're the supply constrained states. So there's not growth, but here in New York, because of what they've done politically, you can't build apartments. There's no apartments. It's
Yeah.
done. Gone.
Right.
But below 96th Street, there's no pipeline. And when you talk about Jersey, I mean, good luck getting a permit to build anything. It's like there's the people that build, right? Like not Jersey City.
Yeah.
Every single other place other than Jersey City. You try to get a permit and like to build apartments in Edgewater, there's like one person that builds there.
Right, yeah.
There's 2 people that build in Fort Lee. There's 4 people that build in North Bergen. There's 2 people that build in Roseland or Livingston. Like it's the barrier to entry is really high, really, really high to create apartments. And the absorption's very, 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 very high. And now with rates going the way that they are, it makes more sense to rent than to buy. So we're not the growth state, but we're the supply constrained state. And I think like in markets like now or in today, I think capital, there's so much supply now that's gone down south. There is still population growth down there, but I think that people are going to be more comfortable being in the supply constraint than the growth states kind of coming into this new cycle.
When you say people, you mean money.
Institution.
Yeah.
institutional capital
It's
is
a flight to safety.
it's a flight to safety. Exactly. It's a flight to
It
safety.
just seemed like, I call
versus
it like
growth.
the big lie. Like everybody was saying how many people left here, like after COVID. But you just saw rents just completely, and it was probably a lot because of the supply problem that we had. here.
Supply.
But I mean, shotgunned, like completely exploded, and now you're starting to see it level off. But you look at these growth states, and I don't follow them as closely as other people. I just anecdotally hear that now you're starting to see rents soften down.
You are.
For sure you are.
Significantly.
You are.
We're not seeing that here. You may see a little bit of a flattening or a plateau, or we have to offer some concessions on new product or whatever. But you're not seeing. Look around here. There's
you
no
and I live in
decreasing.
Tribeca, Andrew. Like, you can't get. I got so lucky with the apartment I just got. Like, and it literally was off market. If you go on market, you can't find shit. You can't
Nothing.
rent.
Right.
Nothing. My buddy just my buddy just rented something.
Yeah.
I mean, it's a bloodbath.
Yeah.
And but what they did was politically they created this.
Oh, yeah.
This isn't like when you think about like big things that happen from a monetary standpoint, right? COVID happened. I wasn't equipped to see this, and I'm definitely Monday morning quarterbacking this for sure. But like, it makes so much sense. Where $4 trillion was injected into the system. When was inflation going to happen? I don't know. But like, was it going to happen? 1,000%.
Yeah.
So like, you saw it. It just launched.
Right.
And it was there. We had cheap cost of capital plus $4 trillion.
Yeah.
Fresh money.
That they were
Rates
giving.
at zero.
They were
Zero.
giving it out to everybody. The
Yeah.
PPPs,
Everyone.
like everyone was getting handouts.
Everyone.
We literally got checks from the
checks from the
government.
government. Literally, all of us. So it was unbelievable. So when you're talking about that, okay, and then you eliminate supply.
Yeah.
So what we're seeing in New York, which is the craziest thing, you guys are, I mean, you see it every single day, right, on the rent rolls that you guys are collecting. I remember when rents were like, dude, they were like $60, $65 was like the highest rent in the market.
Definitely.
The highest rent. Now it's like $100 is like the barometer.
Yeah.
And people are doing 125, right?
Yeah.
And there's a deal that's being underwritten now. It's going to be built now. On Central Park, it's going to be the first rental. You know about the, do you know this? It's going to be like the first rental. It's that the projections are $150 a foot.
Who's doing this?
It's Eckendorf with what's his name? With Spitzer.
What are those? So $150 a foot. What does that mean in terms of like rents for units?
I mean, when you're talking about rents per unit, like let's say, first of all, it's probably at Park, right? So it's most likely, let's call it 2 bedrooms, right?
Sure, yeah.
And let's say the 2 bedrooms are like 1,200 feet, exactly, right? So like 1,200 feet,
Nice units.
150,
15,000.
15,000 a month,
Yeah.
which by the way is high,
But you kind of
It's not
see that
crazy.
if you look at them in
but it's not crazy.
It's not crazy.
No,
It's the craziest thing, right? It's not crazy. By the way, it probably makes sense. You want to be on the park.
Yeah.
It makes sense. First of all, you go to
They're
Street,
small. They're gonna be tight.
you go to Street Easy today. You look at Manhattan, like Lower Manhattan or Upper East Side, $10,000. It looks like a cheap deal, which is insane. I'm saying this, and other people in the other parts of the country are like, "Holy shit!" But like Tribeca, where you and I live, like 15,000 is kind of like the start. Like
So
12,000, you started off.
crazy. It's crazy.
You want it really nice, 25 grand, you get really nice.
Say we're the building that we're working on is like the 1 bedrooms are
They're like $6,000.
Where?
7,000
it's
In
like
Manhattan, or in Lower
$7,000.
Manhattan?
In Chelsea.
Chelsea.
Yeah, and that's Chelsea.
We're getting
Once.
$6,000 in Jersey City.
Dude, Hoboken's crazy.
in downtown.
Yeah.
Like Katerra's property, it's a bigger unit, but I thought it was a typo or something. I looked, I was
The
like,
Reynolds brothers in our office, like they both live in Hoboken, and it used to be like affordable. It's not affordable anymore. He shows me units like 1 bedrooms for like $6,500.
Yeah, we have
Hoboken.
We have a lot in Hoboken.
In Park Slope, I mean, there's units going for 10,000 plus.
Dude, it's scary.
It's
Like
crazy.
Like the building we're working on right now.
Yeah.
So it's politically, it's no 421A, right? So you can't build.
Yeah.
And the fact that you can't renovate apartments and push rents, so all of those units, which we would have about 100,000 a year, that would come off of rent control, right, or rent stabilization in New York City. So it would come out, even if they made it a one-time exemption. So like, it's like, Luke, renovate this apartment, spend minimum of like 50,000 or 75,000, right? You get a one-time exemption, pop it to market, and then it goes back into rent control. There's so many ways of
That would
doing
work
this.
though. That's the
100%.
But that would
that's
fix everything right
no
there.
Supply there, right there too. You're taking half the inventory in Manhattan is rent stable now.
That's right.
Well, look, in Brooklyn, that would work phenomenal. Like if you get a vacant apartment, it's rent stabilized. They let you put your money in, your $70,000 to $100,000. You got it, and that new rent is your new rent stabilized rent or your whatever it is. That fixes the problem, and it allows buyers. It lets people put money back into their buildings because now because there's a return on investment.
That's right.
It allows a bunch of supply to come to markets.
That's right.
The only thing it hurts, I guess, is these like liberal, like I don't know, like who does it hurt?
Low rents. They're trying to keep low rents.
Okay,
in the
but
city.
but now they're low rents. They're trying to keep just vacant apartments.
That will never be renovated.
by the
Yeah,
way,
and they're deteriorating.
What happened with the mayor's that pilot program he was doing with the $25,000 per unit? Did you guys hear about that? They were.
It's not going to go anywhere.
Yeah.
No, they rejected it.
No, they rejected.
Oh, is that what
No,
they
they
did?
teamed up.
Somebody woke up
they
and was
teamed
like,
up,
"This will
like,
be absolutely."
The issue is in New York. The biggest issue, and it's like comical if you like think about this. the people that are the people that are swaying these decisions, these tenant advocacy groups, who have no right to do this and there's no knowledge on this, they like go and they cry and complain and like people listen to them, and that's who's deciding this stuff. It's insane. That's who killed that deal.
It's created big issues in other parts
They're in no
of the
position.
market. It's
They're
like
in no
there's-
position.
It's like there's a cause and effect. And
Yeah.
I know what cause they want, and I think we all agree that it's a worthy cause. But then they didn't consider the effect that it had on the market when they take all these units out, and now there's all this pent up demand, and you have inflation, and it just, I mean, the rents just went to new thresholds that we've never seen
That
before.
happened in 19, right? So like
Yeah.
that
Yeah,
on the
19.
back right before COVID
But
happened.
how does people find
yeah,
the money to
throwing all
buy
that money?
How
you
are
know,
you renting
the
these
sure
apartments? Like these apartments that are for rent in Jersey, New York. Like, fine, there's rents are crazy and there's no supply and the rents are just keep going up and 15,000 this and where do people get the money to do it? Because people are still doing it. I just don't understand how people are affording to live here. I really don't.
So I say it's funny
That's
that
part of our thesis
I don't.
for Jersey.
That's part of our thesis
I mean,
for
not really.
Jersey.
I mean,
The gap in rent.
That's
It's
part
a
of
good
our
thesis.
thesis.
it's a
Yeah.
phenomenal
That was
thesis.
our original thesis in Brooklyn too, and we watched all the migration and all the demand and the rents in Brooklyn go up significantly. But now, and it's still happening. You're still seeing a lot of migration to Brooklyn, but now the rents in Brooklyn are very high.
Close
And
to it,
so these
but
people
not in Jersey.
these people might be looking to live in Jersey or Westchester.
But Derek,
or
now
Connecticut or
Jersey's
Long
high.
Island.
Hoboken, like these buildings, these cookie cutter brand new buildings in Hoboken, $6,700.
That's Hoboken in Jersey City. What about like going a little further
But now you're
out?
going farther, but
You'd
Hoboken.
be surprised. You start to look at like what they've done. I grew up in Union County, right?
Yeah.
So this whole area, Westfield, Cranford, Garwood,
Yeah.
like everything that's happened over there. Now it's even extending down the train into Plainfield. Everyone's all excited about. Plainfield was not a place you even stopped with your car. You just kept driving. So now you start to see these places and the rents that they're getting in places like Union County where there was zero multifamily development, historically speaking. It's all coming now, and the rents are nobody can believe it. You know what Rousseau did in Garwood? There's, it's, the average rent before that in Garwood was probably like you could rent a house for $1,700. Now you're renting an apartment for $2,400.
Yeah.
So,
What about Journal Square even? Like remember when you bought that building, you had that 120 unit on like Magnolia, right?
Yep.
When you first showed, I remember walking that building with you guys.
That's crazy.
And the rents there, like that's a prime location today. Like what are rents in that building?
We had two that we had two deals that we underwrote that like the rents were wildly off what we penciled. One was that I'll never forget it.
That
It
was a
like,
sick building.
that building was wild.
You
Yeah.
underpriced
Yeah.
the projections.
Oh, dude.
I think like our projected one bedrooms were like, I think they were like 1075.
After you renovated it.
Yeah, and I think that like we were getting like instantly without the renovation we were getting like 1350, and then like with the renovation it was like 1750, and it was just like it was a
And that's an old
crazy-
rent. That's years ago, right?
That's
Today-
years ago.
today
We
it's
sold
like-
it.
Yeah.
We sold that. The other one that we completely mispriced was Tampa, was St. Pete. We bought
You
that.
underpriced the projections.
We were like, they were getting $800 in rent, and we were like, oh, I think that we can get like, I think we can get like $1,000. And a year later, it was $2,000.
You guys
I
went
was
up.
gonna say, how did you miss it?
Did you guys go all out there? Like you put like cabanas and pools. and
Tampa, we missed the market to
Underestimate.
sell.
No, you outperformed. Yes, fine.
We
You're
missed
still
the
gonna
market.
outperform
We
your underwriting.
completely outperformed the underwriting. We missed the
Allowed-
market.
Don't
Yeah,
forget what you
basis
said.
By
You like-
underwriting the way you did.
That's right.
Don't forget what you said. You like to leave some money for the next guy.
We do.
You left some
we
money.
do. This was a little too much.
A little too much
Money
meat.
would have been left for the next guy. But that was like two things, so because usually you're pushed to buy a deal, you have to be aggressive with the projections that you make. Those were two that yes, the rents were in Journal Square flew, and the idea there was also we knew one of the developers was going to be building Journal Square, and we were like, what if we buy like the kind of the walk ups, around it, like if that's gonna kind of push up the area.
Yeah.
And we worked hard on getting that deal. That was a tough.
I mean, that was a
one, too.
beautiful building.
That was a sick
Yeah,
building.
great building.
Sick
I remember
building.
walking-
If you
Sick
still
building.
held it right now, though, considering everything that happened last year, you would say probably the timing of it was great.
Interest rates being high now.
No.
Well,
When'd you sell
we
it?
sold it in 2019.
Yeah.
That's a good time
Um,
to sell real estate.
We people talk about selling and how that we never sell real estate, right? Like that was another older theme.
Right.
Never sell, never sell, never sell, never sell. Pass it down. 1031, never sell. I think sell real estate. Oh yeah, because in my you never know when like COVID's gonna happen and like your office
Or a 32% tax
Tax,
increase that just
right?
comes
Or like a
absolutely
32
out of nowhere.
and like you look at families that have owned office in New York City, like monster families for generations and generations. We are looking at office. Gavin is an office person. He's done a bunch of multi as well, but he was an office operator. We think that office is going to end up selling somewhere around like 50 to 30 to 50 cents.
The JC Summit, where we just were, I think
Yeah.
it's 1.1 million square feet in that 525 Washington. 600,000 square feet is on the market right now in that building. The whole floor that we had was
Wait, so where do you
basically-
think office is going to go?
And we're talking
gonna hold
about
you to it.
office. We're talking about office. I mean, we're working on some mez stuff, and it's like, $250 to $350 a foot. I mean,
Where though?
He said 50% off in
In
value.
Manhattan.
in on like Park Avenue South.
Well,
like,
no, for sure. But like the reason is for resi conversions. Like the only way to make sense of those deals, you have to be at $200 or $300 a foot. Right?
Resi conversions don't really work.
They don't.
You know what?
Well,
I'm gonna go on the record and say
they
they
don't.
don't really work.
They don't. One wall right here. That was like a beautiful limestone building. It's not doing well.
Not gonna
At
do
all.
well. No, that's not gonna
Yeah.
be a
And
good
you got-
one.
and you got Whole
We
Foods.
Looks nice.
It looks beautiful.
But if
Great.
you can't
And
make
that
that
one-
work,
great
how are you going to
gym.
make other ones work?
That great gym. The problem with them is that the floor plates are something that everyone knows, right? But then you're talking about in New York City, there's like the loss factor of 30%. So you first have to convince the landlord that's selling it from office that they're going to lose because you
that
grow
basis.
exactly. You're going to
It
sell it
makes
at that.
sense.
The 30% lasts instantly because it's 30% is not usable and you rent in resi
Yeah.
unusable. And then on top of that, the building's not efficient. So then there's like another 30 to 40% loss. So like when you're talking about that conversion, at a certain point, it probably just makes sense to demo the building and rebuild
100%.
versus to like convert. So like there's gonna be some that probably work, but I don't know if you like tour, some of the conversions.
Yeah.
Dude, they suck.
They're
Like they're just
They're not
the
meant
worst.
for it.
Yeah.
Yeah, I mean
The windows, the layouts.
you have to, you're walking, you open your door,
Yeah.
you're walking down like a long
Yeah.
hallway. There's like closets on the left or the right, and then there's a bathroom somewhere stuffed in the middle. Then there's a kitchen, and this is like there's a column in the middle of the thing, and then there's like it kind of opens up, and then you have like a studio or like a one. So it's tough to like lay them out. So I think it was like it was a theme because people are like office sucks. So what can we do? We need to repurpose it. And I agree with the repurposing.
Yeah.
But I don't know how many of them are going to work as
I think
conversions
it's
to resi.
such a small percentage.
Yeah.
I
And plus, you're saying, like these people in Midtown think their offices are worth what, $800 a foot, and there's like, it's actually just worth the dirt. It's like they're not going to. So what's going to happen there?
that's kind of the point. That's
These are
kind of the point.
knockdowns now. Like,
That's kind of the point. So
Yeah.
like for office just in general, I think it's like it's gonna get to such a low pricing where maybe it does make sense. There's also taxes and there's union and there's insurance, which is all off the charts. So like at a certain point, like you can't make it work. Like someone has to pay a certain amount of money
Yeah.
so that you as the landlord can pay taxes and insurance and payroll and have some dollars to put in your pocket or pay debt service. But going back to the family, like there are people that had the opportunity to sell their office buildings for $1,200, $1,300, $1,400 a foot. And they were like, never sell, never sell, never sell, buy more. And then like this happens and it's like,
Yeah.
take some chips off. I don't know. What,
I think you said it right.
diversify and take some chips off the deal. Like
Yeah,
when
take
you
some
get a
chips off the
price that you think is so out of control bananas, I think you kind of got to sell some of this stuff.
Do you ever think that you get a price that's so out of control bananas, or do you always think?
Yes.
I know you think that, but I don't think that other people think that. I think other people think that it's always going to be worth more.
Well, like, listen, a lot of the old school mindset, and I agree with a lot of it, is never sell. Real estate always goes up.
Yeah.
What are you gonna buy? But then you throw in things like, okay, well, now politicians are just gonna change the rules. In 2019, they're just gonna invent rules. And then there's going to be
Invent rules.
pandemics.
That's right.
Yeah.
And the interest rate environment we were in, which was bananas.
Yeah.
Well,
yeah.
that's the other thing. Like I talk to a lot of these guys at some of the servicers that I know, and I say, what do you fear? What are you seeing? Like what should we be looking at like a year from now? We haven't really seen the way interest rates are going to start affecting the rollovers when their debt is maturing, and now you're talking about a whole new cap rate environment on top of added expenses and then lower income because the offices aren't filling back up. Combine all that together and you create just
Cash in refis.
really bad.
issue.
Which is never.
And that's probably
Which is a sale in most
They're all projecting that like 12 months. The next 12 months.
Probably it's a lender.
So
It's a lender saying. I mean, the lender has to make that determination. So we're like, we've been speaking to a bunch of lenders, but the not to go off on like an office tangent, but like my thought was just, you should sell real estate. You should kind of, when you do buy something for, I don't know, like your grandfather bought something for, free, and now someone's offering you, $1 billion for one asset. I mean, like, probably sell, figure out something to do, and then, by the way, like maybe have other things. Like don't sell all of it, but kind of shift some things around. We, in our deal in Tampa, we never projected to make that kind of money, and we didn't make that kind of money because we didn't sell. But but it was like, we bought it for like 40, and like the BOV at the height was like 130.
Wow.
And it was like, we obviously should have sold there, and but the market was changing while that was happening. There was some other. It wasn't exactly perfect like that, but it was close, and
We were at the height of the market.
we were at the height of the market.
You wanted more.
I didn't want more. I was very happy. I
No, it
was
wasn't
very
you.
happy.
You're not a greedy guy.
I was very happy
Yeah.
at that. So yes, like if in certain in situations where you're like that's where you're kind of getting to. I think people have numbers in their heads. I think, and maybe this is helpful for people. I mean, it's a tough pill to swallow, but maybe it's helpful to be like, you know what? Even as families, even as people with estate planning, with all kinds of negative basis, try to figure out a way to take some chips off the table.
Yeah.
You see it though, even the big families like Bill Rudin. I don't know how to say that name,
Yeah.
right? Because he owns just amazing buildings on Prospect Park West, and his family built
Central Park West?
Central Park West. Yeah. What did I say? Prospect Park West.
Yeah.
Yeah. Central Park West. Yeah, he wouldn't dare. He wouldn't dare over there. Central Park West, and he has like Fifth Avenue, and like just ridiculous. I mean, you can't. It's almost like, can you sell that stuff? But he keeps everything. But like families like that, they don't sell. But should they? I mean, there's no basis, I guess.
I think that, like, again, there's like certain things that maybe not, but not to say like we don't sell anything. And there are people that say that. They're like, operate in this world, we don't sell anything.
Right.
Period. We look to buy every once in a while. We'll buy like a building or two, but like they don't sell anything. And this may have just shifted up. I believe anytime that I can take it. I mean, we're promoters, so like anytime that we can take a profit, we sell. Our investors want that. They're happy with it. We want it. but maybe it is an interesting thing to think about as a family when this happens, where you're like, values are only going up, and then you see a cliff, like a full off a cliff, where you were at like $1,400 a foot, and now you're at $300 a foot, and like that's kind of pretty fucked.
We're seeing it from like even in Brooklyn now. We're seeing it from a brokerage perspective. Like, there's a buyer that's buying a lot of finished product. We've done a lot of deals with them, and I honestly think if you have product that they're willing to buy, it's stupid not to sell to them. And there's people still playing around.
Unload.
I'd be like, sell,
Unload.
Unload 100%. And listen, a lot of people are. There's a lot of people that are still playing around. The building's worth 5. They gave me 6, but I really want 6.5. It's like, what?
Yeah.
It's like, should I have taken less?
That's right.
Just get to a closing table.
That's
But
right.
People do it.
Spoken like a true broker.
I mean, but this is an opportunity. Like, I could see this being an opportunity just to sell. And some people are.
Yeah,
some
you don't know
people
how
aren't.
long it's going to take to get that pricing back. Like, if
You
they don't
know
sell
it.
now,
Yeah.
and then they go to it goes like that buyer leaves the market or stops buying, and then you go back to the general pricing.
Yeah.
You're lower.
Yeah.
And you don't know how many years it's going to take until you get back to that
For sure.
$6 million
And interest
offer in
rates
that
are
case.
weird too. It's like real estate's built on interest rates, and they go up and prices go down. And they're low, and people buy at crazy numbers, and that's the way real estate works. It fluctuates. So like interest rates are high right now, and if people are willing to pay at cap rates that don't make sense, like you should sell it.
Less than the cost of financing in some cases.
Yeah.
It's a great
Yes,
point.
100%.
So with you guys and your partners, do you kind of look ahead and set like a predetermined time we're going to start to consider it, or is it more of like we think we've reached this threshold, let's go?
And there's two things that we monitor. One is, where is the market?
Yep.
Because the thing that you always make the most money on cap rate compression, right? Business plan is you have to be good at being an operator, right? Because you get the added juice. But people when you look at people who've made real money in real estate, it's all cap rate compression, and then you have the business plan, right? So it's like you're monitoring both things, but the second that you're like, oh my God, we underwrote selling at a 5 cap and the market's at a 4 cap, I don't care where you are in the business plan. You sell the building instantly.
Yeah.
If you're finishing up a business plan and cap rates are kind of staying fairly stagnant, then you probably want to get through the business plan, make sure that you've kind of added all the value that you possibly can, and then sell at the cap rate. So then we monitor both of those things. But so I would say when we started Skylight, the thing that was interesting is we were trying to get as much connectivity within the group as possible, and we had Gavin and I, who were friends from outside of real estate, and Ben and I, who were friends from outside of real estate, and then Brennan's really running. What's crazy, we were talking about this today that Brennan's really doing what I used to do.
Yeah.
Which is the whole acquisitions. So, and I was saying today that it's it's kind of weird for me that we're in meetings running the business, raising money for the company and where are we going, and then and Brennan and I have been buddies for a long time, and we did a deal in Jersey with a company called True North, and Brennan was over there at the time, and when we started Skylight, we were we need this may be the first time that Brennan hears this. We don't have a track record, right? So it was we were coming together as 4 people, right? But Brendan was at Apollo, and we didn't have a track record. So we were it would be amazing if we can pull this guy in to run acquisitions.
Yeah.
And he took the leap. I think we had a successful deal. But it's interesting to get the perspective from you of how acquisitions are running now versus when we started the bit, like from a
day one.
cyclical,
Yeah.
just from a timing cycle. Like, I mean, we were underwriting and getting deals done, and now it's just like, I mean, it's crazy to think about
Yeah.
like how much.
Yeah, I mean, I think when I started, which was in February of last year, I mean, rates were still where they were. They were, close to zero. And then come time June, I think that was when rates began to gap out. And fortunately, we did a lot of deals from February to June. I think we closed pretty much, except for one deal,
That's right.
all our deals in that time frame.
These are deals in Jersey.
In Jersey, I think it was like 4 of the 5 deals that we got done were all in Jersey, and all within that like 3 to 4 month time frame. We were able to finance them well, and we were buying in markets where we thought that if there was a disruption in rates or in the marketplace, this would be where capital would want to be. The whole flight to safety sort of thesis.
Waterfront,
Exactly.
Gold Coast.
You guys bought some big buildings. I saw like one was like a tower. I think 150 million.
Yeah.
Are these value add deals?
Yeah, that one's a
Yeah.
big value add deal. That I guess the other thought was that when you're talking about people and their living habits, we started buying like walk-ups, right? And when walk-ups got so expensive, and you're talking about like walk-ups in Brooklyn, walk-ups in Manhattan at like $5,000 for a one-bedroom apartment, $4,750 for a tiny one bed. So you can go across the river and I'm not talking about Hoboken because that was something that you brought up. Hoboken's really expensive.
Yeah.
It's not quite as expensive as Brooklyn and definitely not as expensive as Manhattan. And it has a real like Brooklyn Heights-y feel, which is awesome. It really is awesome. But when we're talking about like one of the deals we bought called the Riello in Edgewater, New Jersey, the views are insane. And you're paying like $3,300 a month for a 950 square foot tower, luxury, doorman, concierge, like the type of quality that you get is so much better than what you can get for even like half the price.
You're still going
of New York
you're
City.
still going down
Draws
from
on
that.
the thesis that we had at the time.
And you get views of Manhattan.
And you get views of
So-
Manhattan.
And you get your easily. And
Who are the people that are moving to New Jersey and where they are moving to your buildings and where are they coming from?
So it kind of there's the path, if you will, right? So it's like the largest population of people moving to the waterfront are from Manhattan, okay? And they're going from Manhattan to Jersey City and Hoboken. And then they get comfortable there, right? So like they learn it, they understand it, they are able to go home and tell their friends that like, oh, we moved to New Jersey. Right?
Yeah, exactly.
And then they kind of like get comfortable with Jersey and they're like, well, I'm paying $4,500 a month for a one bedroom in Hoboken or $5,000 a month, for a walk up, unrenovated, right? And I am moving in with someone. And, instead of being in Hoboken for $4,500, I can be in North Bergen or Weehawken in a brand new construction building with ridiculous amenities, huge gym, like ice cream makers and cold brew, whatever, when the whole thing, for like less money than I was paying. And they kind of like gravitate up the coast. So it's like you see that up the kind of the waterfront in Jersey where they like start down here and they kind of gravitate up. And then you have like it's crazy. We bought Fort Lee, right?
that's what it-
So we bought Hudson Lights in Fort Lee. And we were going like
What is the building?
The building is
It's 250 units.
It's a tower.
Tower.
Yeah.
12 stories.
Yeah.
Built in 2016.
Oh, nice.
It's right next to
It's
the big tall.
it's not a
red
value add.
buildings. There's a little bit of a
Bought
value
we
add,
bought
like,
it
given-
well.
Yeah.
We bought it well. I mean, it's a challenge. It was a challenge building. It was like quintessential, like Tucker Development out of Chicago was building it. Ares was their pref equity. Ares ended up foreclosing on Tucker. It was the last deal in their fund, and they wanted out. And they had a deal to sell the entire thing in the middle of COVID to a 1031 person. The 1031 person just retraded and retraded and retraded. So they ended up condoing out the retail portion, which
And that
is
was like the third time they brought it to market.
third time they brought it to market. Exactly.
Yeah.
And
It took a big pill for, I think, investors to swallow in a market that hadn't seen that sort of institutional product ever really trade.
that's
I
right.
mean, that's the biggest project in Fort Lee.
Yeah.
That traded.
Yeah. I
Well, the
mean,
modern's bigger.
yeah, I guess that never really traded.
That never traded. It's never going to trade.
SJP
That'll
still owns
that's SJP and Pru. And that won't trade. But when we bought that, we were
How much
sitting
did you
around.
pay?
What was
How
that?
much did you pay for it?
We had like $420 a door.
Yep, $115 million.
Way below
150
replacement
million,
cost.
okay. Yeah.
Way below. Like
Wow.
to build that thing is every bit of $575 a door. To build that thing today. So
That's when you know you got a good deal below replacement cost. It's like my favorite
And
thing.
built recently.
felt
Yeah.
good.
I know.
There were some issues that we have to deal with,
But I
but
think that's part of the opportunity for us.
That's right.
Where they kind of skimped and cheaped out, given the situation that they had with the developer, and they kind of areas were motivated to kind of just get this thing off their books.
You got a discount.
right?
that's
Throw
right.
some money
There's
in.
things
We
around
sure
the
did.
Edges, as it's on the amenities or in the rooms, where we think we can kind of fix up and see some positive ROI on.
That's right.
And that's in Fort Lee.
In Fort Lee. So
Which is a nice. Everyone talks about Fort Lee being like high rents. Like I don't know it well.
it's
There's those two towers. Right?
They built them. So I say like those two towers.
Yeah, I do.
So we're the building behind that.
You're the guy behind it.
We're the building behind that
I
one.
can't picture it, but I'll
But
check
those,
it out
I
next time
heard
drive out there.
those two buildings. I heard
Monster rents.
you can get whatever you want. for
Monster rents,
Like
monster
they
rents,
asked you get.
athletes, and the whole thing. So what we did was in like investment committee, which we have now at Skylight, we were talking about the theme of what we're doing and kind of like the waterfront theme seems to be is it's kind of like the being able to get a better quality of living and be within ferries really are it's about 10 minutes
Yeah.
into Hudson Yards and into downtown. And depending on where you are and taking the path, it's also like pretty damn close. It's under a half hour, right?
It's very close.
pretty close.
It's extremely close.
It's pretty close. So the thought was we're kind of taking renters from New York, and the rents here are so ridiculous, and politically it's so ridiculous that you have to take a look at what's going on here. And not only that, the buildings are better, right? So it's like not only are you getting a cheaper rent, but like you're moving out of like the walk up and you're moving into a tower with like a swimming pool.
And it's
like,
cleaner.
brand new.
The path is cleaner. There's less homeless people. The only thing is the restaurants are not as good.
So that's starting
need to know
now
where
in
to go.
Jersey
Needs to
City. It's just starting. But what I'll say is, so Fort Lee was.
He's got like maybe 2 restaurants in Jersey.
We went last week.
Well, I heard this is the steakhouse in Hoboken is good, right?
The steakhouse in Hoboken's good.
And what else?
There's that other Agostino's in Hoboken's really good.
People like
It's
that.
it's
I heard
Italian.
this.
There's we went to that place. It's called Local. LOK.
Oh shit, Steve Reynolds here. Steve Reynolds and Tom, his brother, they both live in Hoboken.
They'll
And
rip
Tom will
through.
find good restaurants,
He'll-
but he's complaining. But Steve will eat anything. But
They supposedly just opened a barbecue spot in
Yeah.
Jersey City that's
my friend's
supposedly
place. That's what
amazing.
we
we
went
went
to
there.
our party.
His
Yeah.
launch
How was
party
it?
was there. It was phenomenal. I thought the wings were phenomenal.
He got a chef from Danny Meyer.
That's what I heard. I heard it's really good.
That was
Right,
the best,
right
one
next
of
to
the
Grove
best wings
Point.
I've ever had. Though. I haven't told you that. That is
Well,
good.
well, you say that now after you
friends.
just shit
Yeah.
all over all the restaurants in
well,
Jersey.
you know what I mean.
Porto is good,
Porto's good.
right?
Yeah.
There's like I heard they're doing
endless.
they're
There's an
they're endless.
list.
I heard they're doing a like a bar what is a speakeasy thing as part of the barbecue joint.
That's where we had our party downstairs.
That's awesome. So like it's starting. Listen, Hoboken has like I'm a big mozzarella guy. They have like huge mozzarella. Oh, I'm with 100-year Furies
You
and
should have the Mutts in
Vitos.
Williamsburg, though. The Mutts in Williamsburg, you can't beat.
I will put
Anthony
Hoboken.
and Sons.
We're
Wow.
gonna Hoboken versus Brooklyn.
Local bring it
Mutts
from
test.
from
If it-
Brooklyn.
whoever's listening to this with Anthony and Sons on Graham Avenue, Williamsburg, it's the best Mutts I've ever had. Even
But
he knows.
The podcast guy likes
I
it.
will say, Vito's in Hoboken is very good. I mean,
Okay, good.
Fiore's is amazing. The twist. So when we sat around the investment committee, the idea was Gavin was like, you know, where are we drawing these people from? We're in Fort Lee now. Like I understand. He was like, you know, the waterfront thing is cool and it makes sense from a thematic and thesis standpoint of what we're trying to do. But he's like, now we're like all the way up there. Like, what's driving this? And Brennan did the work around. We're like, who's living here?
Yeah.
Columbia Hospital. There's again because of the lack of supply of new product in New York City, even uptown.
I mean, the university up there owns everything too, so it's.
Yeah.
It's Columbia Hospital.
Yeah.
I would say
living-
60% of our tenants, they're just
demographic of
they go
People
across the bridge. So there's
Yeah.
there's the dollar vans, and we have a shuttle.
Also, yeah, exactly.
And it's cheaper, bigger, and basically the same commute.
Yeah.
So
How often did your shuttle come?
I'm not sure. but you can.
It's interesting though.
But you can
come
walk.
up with solutions.
You can walk. So we have a shuttle, right? You can also walk down. I know this. Growing up in Jersey, from the building, it's 2 blocks, and you walk downstairs, and there's the dollar vans, and they come every 30 seconds.
And we also offer parking, like
Yeah.
you know.
And there's a ferry as well, or
There's no ferry in Fort Lee.
Yeah.
Fort Lee, you can drive down to Edgewater,
Right.
and you can the closest ferry is the Edgewater ferry,
Yeah.
which is fine, and people take it. But if you're working at Columbia, that dollar van or the shuttle,
You're driving
How
in.
much less do you think the rents are in your building versus a comparable unit in that part of Upper Manhattan?
our ones are like about $3,000 bucks.
$1,000, yeah.
And
Yeah.
and I would say that uptown
They're
there,
like 800, maybe a little under 800 square feet.
yeah, I would say up there they're probably around
Comparable
close to
building.
$4,000. So it's like $1,000
Yeah,
savings.
for the
For
unit
wait,
size
wait,
is
wait.
probably way
For
smaller.
a property up in Manhattan that has a pool, that has
Yeah.
those kind of
Yeah,
amenities.
Manhattan doesn't have a pool.
Well,
Has
that's
a
what I'm saying.
parking.
If you're going to compare, if someone's going to look for
It doesn't
amenity
even
packages,
exist.
exactly.
Yeah, what I'm like,
Exactly.
let's take like fine, it's Fort Lee. Let's take a market like Hoboken. You
Yeah.
bought that beautiful red loft building for like $57 million in Hoboken, right?
Yeah.
Thing is sick.
I love that thing.
All right, so what are you taking in, like who's going there? I'm sure
That's
those
a
are-
weird one.
Why?
That's a weird one. Because first of all, it's doing great.
Yeah.
But it's a weird one in the sense that it's very, very unconventional. Because the units, it's 99 apartments, every single unit's completely different. So because of that, there's a lot of lofts.
It was a conversion.
It was a conversion. It was an
Industrial.
old pencil and surveying manufacturing building that was converted, and then by this guy that ended up failing, and Larry Gluck bought the debt and then sold it to Greystar, and then Greystar sold it to Blackstone. And we bought it from them, and the deal is, because of the funky layouts and the stairs, and a lot of them are 1 bedrooms, people don't stay that long. Like, you can move in as a young professional, let's say, you're you're probably not moving in right out of college, right? Like you have to like get a job and then like work a couple of years before you're moving into like something like that. But then I would say like, let's say if things are like going well by like the age of like, let's call it like 23, 24, you're moving into there, right? And then you like meet someone and you can live with that person in that apartment, but like that's it. Like once you get, if you have a kid, you have to move. You have to. Like the one bedroom's downstairs, the one bedroom's upstairs. Like it's
But isn't that
funky.
a good product for Hoboken? What
It's
you have?
awesome.
Yeah.
But it's not.
I think of where it is too, kind of that part closer to the train, right?
It
generally is a younger demographic.
It is a younger demographic. It's not when you say it's not family product. Like Riello is more of a family product. Like that Edgewater deal that we bought, the Infinity deal also more of a family product.
The layouts just don't accommodate.
They don't accommodate.
Do
for
you
it.
think that family layouts is like the direction of the rental market at this point,
In Hoboken?
just in general?
Yeah.
Like,
Yeah.
are we
That's
talking?
kind
Is
of our
like
thesis
is,
behind the deal that we're
is
doing
like
in
is like
Chelsea.
is the rental market just like
Bigger units.
Is the story about millennials that are starting to have families and need more space and like need to like pay higher rents? Is that what's going on in the rental market in the region, or is that not the story?
I mean, listen, people spent the last 10 years building small apartments, right? Like that's been the theme. It's high price per foot. And how do you get that? It's through the illusion of having a apartment, but it's small. It's so like you're building 550 square foot one bedroom apartments. There aren't as many family apartments on the market, and now you have interest rates that are through the roof. And by the way, that's just kind of driving SFR, right? Like that
What's
whole
SFR?
business, the single family for rent, is like that whole driver is what you just suggested. It's like it's not even a family apartment. This is a house that they built for the rental purpose because it makes more sense to rent a home than to buy a home.
Yeah.
For sure.
So that's like townhouse living. That's SFR. Yeah, I mean the problem is getting from an investment standpoint is getting it perfect from an ROI because it's expensive to build, right? And
SFR.
build in general,
Yeah.
right? So you want to, if you're building apartments, right? Let's say, you're going back to your question. If you're going to build apartments, you're going to build high rise. Let's say you're going to build Jersey City, right? Then like if you want to build a family apartment, you don't want to overbuild it from a square footage standpoint because you pay per foot to build. So then you need to make sure that you're going to get the max per square foot in rent for that unit. So like if someone's going to live on, we were talking Central Park West or Fifth Avenue in a rental building, they're not building like a 2,000 square foot 2-bedroom apartment. They'll do that for a condo, right? But for a rental, it's like 1,200 feet.
Yeah.
They want to make it as tight as possible where like someone's like, I live in a 2-bedroom, and it costs them whatever it costs to build 1,200 feet, not 2,000 feet, and you're gonna get the same rent.
Yeah.
That's the issue. That's the issue with these new construction buildings. They take it costs a lot, and there's nothing about it. That's why like
Every square
not
inch.
to talk about Tribeca again, but like it's loft and it's old, so it's like you still have living rooms
That's
and you have
right.
other things. Like,
That's right.
These new buildings, they just don't do
So,
it.
They don't-
so are one beds like not the units that are most in demand right now? Because like there was the whole coming out of COVID where like people were doing the whole roommate thing and then people wanted to live on their own. So like the one beds were.
You guys don't do condos, really. But the data that I see shows that the larger units are actually generate on the condo sales much higher price per square foot. It's like the reverse of rentals.
That's interesting.
Yeah.
Well, on condos that makes sense.
It
to
has.
me.
See, I look at it because I keep thinking there's going to be this, like it's going to fall out, like it's going to start to come down. It hasn't, and I think what you just said there is exactly supporting that. Why? If someone's going to go and they're not going to go into a house or whatever, they are going to buy something. They're going to pay a premium for a larger unit that they're going to go into, and on the rental side, they're still. It's kind of reverse. The smaller units are still getting the higher price per square foot. So that's what the data supports. I think that's probably the thesis behind it. Is why.
It's also it's also very, very cyclical in the sense that like
It is.
interest rates play into this stuff, and seasonality plays into this stuff.
For sure.
So like, you know, it depends.
Yeah.
But I think that 1-bedroom apartments are definitely, you know, like, depending on the time, I would say that, like, you know, seasonality drives a lot of those 2 and 3 bedroom units.
And ones they rent. So
Oh yeah, for sure.
there's nothing like renting a good one to
I
like
guess,
a couple.
you
It's
know-
the best way to do it.
I guess the issue that I have, I recently had a nice brand new building. It's all 1 bedrooms, and I submitted it to a buyer, and the buyer, I thought it'd be a good fit, and the buyer said no, like, it's all 1 bedrooms. I don't want to buy it.
See, like,
that
I
was
li-
that
I
was
like
his
1
objection.
bedroom. I like 1 bedroom.
But I think people are paying up for space now, right? Like,
Yeah.
and I think that's what you were kind of alluding to.
Yeah.
right?
I don't know. I mean,
Everyone's
and
stretching
I
for
think-
space.
Right. And for like a lot of people that are living in the city that were hoping to move outside of the city, maybe into a home, you know, there's nothing to buy, right? Like the housing stock,
Yeah.
you know, in the suburbs, like I know of a ton of people that tried to buy.
Yeah.
Prices
Prices went up.
prices are still too high,
Yeah, because if
and
you
now interest
sell-
rates are high, and
now
prices
rates
haven't
are
come
high,
down.
no one's
exactly
gonna
right.
sell,
That's right.
So there's inventories at an all-time
If you
low, so
sell
what are you
right
gonna do?
now, what's your reason for selling unless you're going completely out of the market and you found something else?
Yeah, good
It's
point.
not like you're going to sell and be like, oh, I'm going to move into something similar because you're still competing in the market. That's a challenge. So it's like people are sheltering.
Yeah.
You
yeah,
know,
I
in all
mean,
their
you're
houses.
you're
They're-
buying and selling in the same market, right? Like that's
Yeah.
what people say. So right, so it's like a buddy of mine that is literally put his house up for sale in Millburn today, actually, and he's in contract to buy another house in Short Hills, but same thing, right? And he's like, there was a bidding war on the house that I am buying, that I'm in contract. And he's like, there's a frenzy, or there's already people lining up to see this house. Again, it's like a supply demand thing in these particular markets.
Wow.
In places like Florida, where you're like entitling a farm and just building like tracts
Yeah.
of like single family housing. Sure, like it's not as in demand, right? But there's so many things that go. I mean, the school system is another big factor, right? So like you're gonna buy in these towns and you want to send your kids to public school, you need to be in the right town. That's tremendously driving, right?
For sure.
And then like there's not that many lots that you can get to build something. The other thing that people forget is that until COVID, the suburbs were not that desirable.
Not at
Like housing was like, yeah, get out of here. But I think that like there definitely has been shifting back to regular apartment living, where like people are starting to come back to the office. I mean, you go to office buildings, like the lobbies are full, even if it's 2 days a week.
Yeah.
In New York City, in Manhattan. And so it was like a roommate thing. People were like, ugh, not doing roommates anymore. It's gonna be work from home. I need more space.
Yeah.
Yes, but like, and people have been doing like the co-working thing, right? Like, yes, in amenity spaces. I think it's helpful. But I think that like, we're kind of coming back to regular life as time is kind of going on, right?
sure.
So I think that the smaller units are still gonna be fine. I think that
Yeah.
1 bedrooms are fine. You don't need like these small share twos, which people were like talking about doing. I'm sorry, the small share twos I think are going to still do fine. Like people will move in together to like.
I think both things are going to be.
Yeah, I think they'll both.
And we're kind of seeing that in this deal that we're actually.
That's
looking
right.
at, right?
That's
Like,
right.
Where the 1 beds are pushing up against where the 2 beds.
Yeah, that's
are
right.
being leased.
That's
And
right.
We're like,
You see that? We're seeing that.
Yeah, I mean,
That's
it
right.
comes down
probably
to
push those
yeah,
twos a
for
bit
sure.
more. Yeah.
That's right.
Yeah,
That's right.
It's just so interesting. I mean, I feel like the last 30 minutes we've really just talked about. There's just so much demand in the market right now. It's just crazy.
What's happening in Jersey,
you-
from what I can see,
Yeah.
like with the rents, is insane. I mean, but Jersey has a lot too. Like Hoboken's an incredible place. Jersey City's an incredible place, but the rents are starting to be like. You looked at Jersey like last year, and it was like affordable, and now it's like you look at rent. I know I talked about this earlier,
Yeah.
but it's just insane.
Yeah.
The craziest part that I think is being someone that like pretty much lived there my whole life, is how it's spreading further and further out. It's spreading
That's the next
further.
step.
It's spreading further and further out, and it's just going down the train lines.
That's right. That's
And
right.
That just wasn't a thing. You know, it was like here, and then it was Morristown. There was an extension, like there was Montclair.
That's
There
right.
were some of these other towns, but now it's just everywhere in between. It's just filling in.
Yeah.
So
It's crazy.
It
It's good
is.
to
Also,
see.
it's good.
yeah.
How about the equity markets? How's equity and capital for deals right now?
Shut down.
Why? I feel like there's a lot of liquidity in the market.
The reason why is from institutional capital.
Yeah.
Is that everyone has investors, right? Like it's all every single person that we're raising money from has investors.
Mm-hmm.
So if you have an investor like a state pension fund, they don't want you to be a hero. They're seeing
Yeah.
rates and uncertainty in the market. They're investing with you, and their teachers are investing with you because they want you to be safe. They want you to just. There is a tremendous amount of uncertainty of like when are rates going to come back, when's cap rates going to come back. So they're just sidelining. The other thing that they're saying all the time, that they say all the time, and it's kind of interesting, is it's like if we can put out money today and get, let's call it low teens on debt, gap financing, whatever you want to call it, mezz,
Purchasing debt. Or
originating
debt.
originating or purchasing debt. They're like, why the hell am I doing equity? Like, it would have to be so compelling for me to do an equity deal.
Raises the bar for the equity expectations.
That's what exactly, and then you have this disconnect between buyers and sellers. So it's like it's almost impossible. So you have like they are willing to do debt, but it has to be like at what we were talking. It was equity like returns 2 years ago, right? 13s, 14s. We were buying apartment buildings for on levered IRRs. And then, so now they're putting that into either originating or buying debt, right? And there's not a whole lot of that selling, but it's starting, and there's gap financing that's going to start, and that's where it's priced. And they're like, so we're not going to do an equity deal.
Yeah.
By the way, particularly if like that guy needs a 4.5 cap, like he needs a 4.5 cap in order to get out because he bought it for a 4.25 cap and he added some value, but like,
Yeah.
so that's not happening. There's not much value left. I'm getting to a 10 IRR on that thing, and I'll just buy debt at 12.
You could literally give Mike a Goldman Sachs is at 5.2% right now.
That's the point. We were talking.
Yeah, that's a big problem.
We were talking to so like the person, someone that we thought was interesting was like a hedge fund about originating some debt on office, and I think it'll come, but they were like, where do you think?
On what basis?
Beyond the base, they were like, what do you think the yield is? And I was like, well, there's a current yield of like 8, and then we're gonna have a kicker on the deal. And they're like, we'll just buy Boston properties. Like, why don't we? If we believe, if we think that there's upside, and we're gonna want an 8 yield, like if that's the exposure we want, we'll just buy Boston properties, right? So it's like, it's a tough time to raise institutional capital. Having said that, I think it's a good time for the private markets, right? So I think that like private people, we were talking about this, they buy for whatever, like their kid just finished college and they own a bunch of real estate and they have more cash flow.
Yeah.
What are we gonna do? Buy a 8 unit.
Yeah.
We're selling this deal because my cousin's a partner, and I'm gonna 1031 it. It's just they don't care as much about the markets. Our investors are highly scrutinized because they're constantly raising. That's their business, is raising money from large pensions and endowments and sovereigns, and you have to kind of the herd mentality. You have to kind of like
The same private pensions
By the way, it's all the
They're
same.
all trying to
It's the
perform
craziest thing. It's like, right? It's like,
They just throw
like,
their money around with a bunch of different groups.
for example, CalSTRS is a part has money with one private equity fund, and they also have money with another private equity fund, right? And you buy a deal. We buy a deal with one private equity fund that's going to be our equity. And it could be that the debt that we get from our deal is another private equity group, which also has an investment from CalSTRS. So CalSTRS is in the debt and the equity of this. It's like crazy. It's so incestuous on the institutional front. Everyone knows everyone, and it's kind of like, even if you do something that's heroic, they kind of like, look, they don't want that either. Like they're like, if we bought an office building with Aries, and they were like, guys, we think this is going to be amazing. This is not happening. But I was giving an example. $200 a foot on Park Avenue South, right? And we crush it out of the park, and it's a 10x. At the end of that wind down, like those partners could be like, great return. It's kind of a little bit wacky what they did. And you know what? I don't know if we really need to like re-up with them.
Come
like,
on.
I swear to God.
I believe that.
They're like
sure.
we don't need the fence swingers. That's not like, please just don't lose our money. Just don't lose the money,
Wow.
and we'll keep re-upping with you.
So it's
We would like for you to outperform, but we don't need someone who's gonna like do something tremendously contrarian.
Wow.
And that's when you find like monster family offices, right? Like huge family offices that have a ton of money that will do institutional sized deals in a contrarian way and like take a position. But we've already seen like people, firms that have made contrarian bets, and it hasn't penciled out well. And it's going to be challenging for them to raise money going forward. So it's like, it doesn't like when you're running money for an institution, you're making your money on promote, but you're really making your money. You're a money manager, and that's fine. Like that, no one purports to be anything other than that.
Meaning that you're making money off the AUM fee.
That's what I mean. You're making money off of AUM. So all they're saying is
What's
just
AUM?
like is assets under management,
Got
right?
it.
So it's like they're going to give you, STRS will give you $1 billion, right? And then you
They
whatever.
charge a 1 or 1.5%.
Yeah.
Percent management fee, and then the state of Tennessee will give you $250 million, and then you raise all this money, and all you want to do as the manager is just don't fuck up. You're gonna raise.
Get to your
You have
next fundraise.
you have fund
Don't do
one.
anything too stupid.
You have fund one, fund two, fund three, right? So you're generally you're raising fund three, okay? Fund two is out in the market, and fund one is on wind down. So if you have like 3 $2 billion funds that are out, which is generally kind of like, if you have a 1.5% management fee, you're just like, don't do anything stupid.
keep the
Just
car here. It's
on the road.
But you see it with the hedge funds, right? The top hedge funds, like they all have like these huge fees, but they're also trying to make a rip, right?
The
Why are they
hedge
doing that?
funds are different
Yeah.
because the hedge funds, I was having this conversation. I hope this goes viral. We in the real estate business get a little bit screwed as stewards of capital, and I'll say that in that they're getting a little bit smarter on the hedge fund side, but hedge funds don't have preferred returns, right? So there's an alignment of interest issue sometimes on the operations side or the investor side, the sponsor side on real estate, because you have this pref that's clicking with your investors. So like for us, is we're looking to make our promote and sell, right? Hedge funds could take a longer approach. They can take like they once you get everyone their money back, it's basically a multiple game, right? If you get them their money back, and then automatically you get 20% of the ops. We have this phantom pref. That's not very phantom, but it's clicking every single year, and it makes hedge fund investing, they are more incentivized to swing for the fences because the amount of money that they can make without having this pref clicking is astronomical, right?
They can pay themselves $4 billion a year.
Right, but like, by the way, and it's crazy. The investors know it, right? They're like, I'm investing with this person. They're gonna. I mean, it's wild swings. Like, I'm hoping that they don't lose the money. There's like downside for it, and they're hedging it properly. But like, it's swingy, but there could be a ton of money to be made. Like Ken Griffin. I mean, it's ridiculous, right?
$4 billion
last year.
I know, right? But
And a ton of money to be lost.
and a ton of money to be
Some of these
lost.
funds go out of business.
That's correct. And they go out of business. It's not real estate people generally, which is amazing. You can have some bad deals. People don't generally go out of business unless you like want to go out of business. Like hedge funds go out of business.
I'm
You're
thinking.
gone.
I'm thinking of names. There's people's names that are coming.
Oh, there's
to my
tons of guys that we do
mind
business
are
with
still
that have a
active.
lot of bad deals that are still buying
They're
deals.
still buying
Everyone
deals.
still says,
Yeah.
"How the hell is that guy still buying a deal?"
Yeah.
You try to like do something like like you're not making something like some crazy bet. So that's why. Listen, if you have a contrarian play, you probably are raising money from not the typical institutions. Some institutions have like small allocations to do something contrarian, but generally they want to kind of follow the herd. So that's why still debt, distress, debt, great today. The herd loves it, right? It's like such a great buzzword for everyone. And then you have industrial, right? It's industrial. That's that people still seem to like it. Although rents are starting to kind of slow, but it's like people still seem to like.
Yeah.
It's like industrial with cold storage, self storage, SFR, life science, and debt.
I hear the storage a lot these days.
That's like kind of.
Storage makes a ton of sense. It does, especially in New York.
Yeah.
I mean,
Yeah.
people are talking about it like crazy.
You have supply issues.
That's something you can do in an office. You can make it storage.
We're talking vertical farming.
Okay.
I knew you were gonna get
that. That's where
Cool.
institutional
Yeah.
capital is.
Nice.
Yeah.
We're gonna have to do a part 2 and have you come back and talk about
Yeah,
how
I
do
love
you
this.
how do you
It's been good.
how do you get those
It's been-
conversations?
yeah, it's been great.
How do you get through those doors? of the
2 hours.
institutions?
Yeah.
All right. Anything else
I
that you
gotta
guys want to
figure
go over?
This is like every day.
This is every day.
We'll have a follow-up episode in 6
Yeah,
months
I
or a
love
year or
it. I
something.
love it. I love it. It's been awesome.
Andrew gave us one of our first big deals when we started this firm at BRJ at 1000 D in the first office, Linden Street. Remember that?
Yes, I do.
So thank you.
And
We did.
Decatur too. Didn't we sell Decatur for him?
Yeah.
Did
Just
we?
in parts,
Yes.
yeah.
Yes, we did. We did. And
did.
but Linda was nice. We started the firm at $6 million deal. Appreciate
That
it.
No,
was-
not
Getting
6. It
there.
was 9. Come on.
Was it 9?
Yeah, of course.
Linden?
Wasn't
I
it?
don't think we got that. I think it was 6.8.
Maybe I'm wrong.
No, I think it was.
Is it 9?
I think it was
9.2. It's 9.2 million.
All right, come on. We
9.2
gotta get up to
million.
speed here, Lucian.
Yeah. And you were getting married. I remember that. You were getting
All
married.
right. So
Excellent
yeah,
day. That was good.
Andrew,
Yeah.
good buyer.
Thank
Good luck.
you.
Thank you.
Just Brennan, great seeing you.
Thank you.
Thank you very much.
That was awesome.
We'll call it there.
Thank you.
Awesome.